Here with me now is Simon Kennedy, Bloomberg's chief international economics correspondent, and also with us is a central banker who served as World Bank chief economist and first deputy managing director of the IMF, Stanley Fischer, governor of the Bank of Israel. Welcome to this programme. Lovely to have you with us. And so let's just pick up on that point, Ben Bernanke. I mean, what did you make of the comments that we heard last night, the prospects of rates staying lower for the next 3 years and, of course, QE3?
Well, they're both expansionary. We've seen the dollar fall a bit this morning. That was to be expected. And it provides a pretty strong background against which people can make their plans for another two and a half years. That's a long time, actually 3 practically.
In your own economy, you've cut rates 3 times in 5 months. You did so again this week. Are we nearing the end of the loosening cycle in Israel?
We don't know. We're following developments in the international economy and in our own economy, and if we see growth slowing, we'll be willing to do more. If it stays roughly where it is, need to do more will be a little less, but we don't commit at this stage.
I mean, just picking up on that point about the international economy, how worried are you about external shocks, particularly the prospect of a messy default situation here in Europe and the ripple effects for, well, your country?
Well, everybody's worried about that. I think we've all internalized that Europe is going to have a recession, small or medium, this year, that we can all deal with. What the implications of a financial crisis will be, we really don't know, and that's very bothersome. You do scenario planning. We always do that. It's very hard to describe the scenarios in this case, and that's unusual.
Your forecast in December is a little higher than the one the government came out with this month. Is there room for a rethink there? Has the outlook changed in just a few weeks?
It's the other way. We're at 2.8 and they're at 3.2.
Oh, sorry, yours is a little lower, sorry.
And, well, I hope they're right. And we'll be very happy if it turns out more than that, but that is what we calculated.
And you continue to stick with yours?
Well, for a month, it's kind of a minimum period. No, we've seen nothing to change that forecast yet.
And if we broaden things out to the region, we've seen increasing tensions between Iran and the West, as you well know. Will geopolitical concerns be, well, very much in the forefront of your thinking in the year ahead?
It's not in the forefront because it's relatively a stable, threatening presence in the background. And we take that into account. I think the markets take that into account. If there are dramatic developments, of course, it will become a very serious change in our situation. As of now, we're operating in a region that looks more or less within the range of expectations.
You've increased cash reserves, though, to record levels. One of the reasons you've cited is those geopolitical concerns. Of those, how much is Iran the concern?
Oh, I can't quantify that. A lot of things have happened, including the Arab Spring and changes in our relationships with some of our neighbors. And so it's an overall appraisal. We don't divide it up, and they're correlated anyway.
If I can just go back again to what we're seeing in the US, the prospect of more quantitative easing. This is something that's come up again and again, the effectiveness of more QE. And a lot of the guys that we speak to say, look, in developed economies, the policy cupboard is bare. These guys have got nothing else. If we had QE3, is that going to be effective? Is that going to do anything, especially when you look at challenges like unemployment, which is, many say, is a structural thing?
Well, people always say it's a structural thing until it starts going down, and then they discover that it wasn't. There's an aggregate demand element, and that's a serious part of it. I think the quantitative measures work. If you compare them with the 0.25% or 0.5% on the interest rate, I think there's an equivalence which you can find. And I think they should do what they can, and I think it will be slightly effective. I think the Fed's been very good, very effective, and has changed the situation.
Going back to Europe, you've had some experience of crisis fighting in your time at the IMF. If you were at the IMF now, what would you be telling Europe needs to do more?
Oh, I don't like to second guess, and it's a complicated situation. Some of the fund's chief shareholders think Europe should do it all by itself and don't want the fund to be in there very much. And I think the fund has a lot of knowledge to contribute precisely what the financial sharing should be. I'll leave that to shareholders to decide.
Are there lessons, though, to be learnt from the Asian crisis?
Well, there is a lesson to be learned about trying to get problems solved relatively quickly, and I'm talking about structural problems. On the fiscal side, there is a lesson as to not to be too ambitious, too fast in cutting deficits. But I think those lessons on the macro side have been internalized. I'm not sure that the lessons on the structural side have been having an effect as yet, or the effect that they should have, and it varies among European countries, as you know.